All right, well, welcome to our Investor Lunch and Learn. Again, my name is Eddie Bodkin, and this is my partner, Yesenia, and today we're talking about understanding private money. So just by show of hands, how many of you have used a private lender on a real estate transaction, or you've been a private lender on a real estate transaction? Okay, so about half of you have. Awesome. So who has not used a private lender or participated as a lender in a transaction? Okay, gotcha. Who just wants to know more about it? Okay, should be everybody. Awesome. All right, so before we get started, I just wanted to go over this quick disclaimer that this is just for educational purposes. It's not an offering to sell securities or any other specific investment opportunity. And just make sure to talk to your CPA or tax advisor. So this is just a brief background of my real estate experience. I've been investing in the Chattanooga area over the past 8+ years, about 8.5 years now, going on 9 years. And I started out doing short sales and wholesaling. And I did that for a couple of years, and I got into rehabbing, and I'm a real estate agent. I do that as well. I focus primarily on investment properties and commercial. So primarily my experience in real estate has been the active side of the business with rehabbing and wholesaling. I'm also a real estate coach for a national real estate education company, and I've been doing that for the past 3.5 years. Yeah.
Hey guys, how's it going? My name is Yesenia Vazquez-Rosa. I originally started my business in Hawaii. I've been in Hawaii for about 16.5 years, and I'm now in this beautiful mountain area. I've been in the business of over 14 years. I started with rehabbing small condos because that's all I could afford, right? Until I started getting to know more of the lingo of private lending and all that. Then I got into single family homes. Right, and then I specialize in commercial mixed-use, multifamily apartment buildings now, and new construction. That's what I focus on now. I'm also a real estate coach for a national company, and I'm also a business coach. So I help business owners scale their business. I am a licensed agent in Hawaii, and I am a proud U.S. Air Force veteran. Any veterans out there?
Yay.
All right, nice.
Can you guys hear in the back? I just want to make sure because somebody said they couldn't hear. Okay, you're good. All right. It's just, it doesn't go through the PA.
So this is the overview of today. We're going to talk to you about how to structure a private money loan, how to use private lenders in your business. We're also going to show you the benefits of becoming a private lender. We're going to show you how to utilize your retirement account as a private lender. And we're also going to talk about private lending best practices. Okay? So who can tell me what a private money loan is? Anybody want to speak up? No, you don't want to speak up? All right. It's really simple, right? It's a real estate loan funded by people like you or people like me that have savings accounts or retirement accounts, and we put it to use. Okay? So this leads me into the loan structure. So Eddie over here, he's got money to lend. Right? He's the lender right here. So he comes to Grace and he says, Grace, I got this money, I got 100 grand in the bank, I want to put it to work. Right? So at that point, we write up all the documents, right? Secure the loan, and then we purchase a home. Purchase that home. Eddie does what he does best. He makes that house beautiful. He rehabs it, and then Grace turns around and she sells it. Right? At that point, you get your 100 grand back plus the interest that we negotiate. Okay? That's basically an overview of how this goes. Okay? Here's an example, right? So we purchased a house for 60 grand. We put in about $40,000 worth of rehab costs, and then that's a total investment of 100 grand. Okay, again. Once Eddie's done with all his beautifulness of making this home beautiful, right? The return, the private lender gets their money back of 100 grand. The interest rate of 12% that they negotiated at the beginning of the project. And then you make $6,000 in 6 months. So that is an example. Okay, so here, when I first in Hawaii, when I first started, I'm going to give you a little story. When I first started, it was really hard to get banks to back up my business, right? So I learned how to leverage other people's money, okay? And this is where the private lending world came, and it took my business to another level, right? So by leveraging other people's money and by having flexible terms, I was able to close more and more transactions, right? And this is what it can do for you. My first presentation of private lending was to an old Air Force supervisor that I had, right? He has known me since I was in my 20s. He kind of saw me like, hey, what are you doing with real estate? How are you doing that? How are you getting the banks to back you up and stuff like that? It's like, well, you know what? Let me put a presentation together for you, okay? I have a project that's coming up. Let me put that presentation on. What I did was I did an executive summary of it, right? I put the subject property, its pictures, and I told him what I was going to do to it, right? And then I showed him the comps on where I could sell the property, right? So within 30 minutes, I was able to raise the 200 grand that I actually needed for this project to be done. Now the numbers are a little bit different in Hawaii. They're pretty expensive over there. Even for a shack, you're paying a lot of money, right? So I needed to really learn how to make this work, right? So the private lenders are the glue to my business. They're really the what has helped me scale my business, and I know, and I've helped other people do it too, and they can help you as well in your business.
Yeah, I just want to say real quick, because someone else had a question earlier about the difference in hard money versus private money, and really the best way to look at it, even though those terms can be, or many people use those interchangeably, typically when you talk about hard money, you're talking about a company that goes and they raise capital from private lenders, and usually they broker that out, or they may use a combination of other people's money and their money, and they broker that out. So typically with hard money, most of the time the terms are fixed. But with private money, you're just dealing with an individual. So that's how we're defining that here. So the individual, the reason there's flexibility in terms is because whatever interest you pay as a borrower to a private lender, it just comes down to whatever you can agree on, whatever's a win-win for both of you. So I just want to clarify that, because someone had asked that earlier, just the difference in hard money versus private money. So that's what we're focusing on here is private money specifically.
Then a note on that, hard money lenders, they're for service, right? So they set their own terms. There's no negotiating. Private lenders, it's relationship based, right? So we have flexible terms and we can negotiate. So it's a win-win. All right, so who here can tell me who can be a private money lender? Anybody,
yeah.
right,
Yep.
right. Anybody
right.
can, right? So, you know, if you have a bank account, or if you have a 401k, you know, if you have money just sitting in the bank, it's not doing anything for you, you can be a private money lender. Okay, so how does the bank make money? Lending it out, right? So what we do is as you put this in your business, right? For me, I call it my private lending team. Okay, we cut out that middleman, right? Because that middleman, your money that's sitting in the bank, the middleman, they're using it, okay, day in and day out, right? They're making more money on your money than you are making yourself, right? So we changed that, okay? We cut out the middleman, okay? And I believe this is your turn.
Yeah, just as an example, if you have your money in a bank account, really, you know, this is actually being generous. Like if you have a bank account or a bank CD that's getting 2%, which is, you know, still fairly high right now, but some will still give 2%. This would be a comparison of how much you would make on a 12% private money loan versus just 2% in the bank if you just add it up. So there's obviously just a major difference in what you're making as a lender versus what you're making in the bank. So, and also, when you even just consider inflation, if you just have your money just in a bank account, I mean, getting, a 0.5% interest, and you consider inflation, you're actually losing money. So, so that's why you want to consider, what are some other ways that you can make your money work for you. Okay, so I'm going to go over the benefits of being a private lender. We've talked about how to use private lenders in your business, how to use other people's money, how to leverage that money. Basically, when you're an investor borrowing the money, you're leveraging private lenders' money to do more deals. That's how you're able to scale your business. Okay, but what about on the lending side? What happens there? So the first thing I want to look at is double-digit returns. Now, if you're a sophisticated investor and maybe you've been doing real estate for a long time, then you can get double-digit returns doing, a lot of different things. You can do rental properties, you can flip properties, you can do other things. But it also takes a lot of your time and energy and typically a significant amount of real estate or investing education to be able to get there. But just as a private lender, you don't have to have any real estate experience unless you want to. Now it's good to still understand, enough to do some due diligence on your borrower and also on the property and the investment. But you don't have to have any real estate experience to be a lender. So you could forego all of that education and time and energy involved in that and be a lender and still earn double-digit returns. So that's one of the benefits of being a lender. The next thing is predictable returns. So when I say predictable, I'm just saying that whenever you go and you lend on a real estate deal, okay, you know what you're going to make as compared with the stock market. Yeah, you might do good for a while, then it may go down, then it may go up, then it may go sideways. But when you're lending money on a deal, there's predictable returns because you have the promissory note with your borrower, so you know what you're going to make from start to finish of that project. And the money is also secured by real estate. And this is also one of the best parts of lending, is that it's secured by real estate, which is one advantage. It's a hard asset versus with the stock market, it's paper, it's not anything physical. So with real estate, it's secured against a hard asset, but also an asset that's purchased below market. Like, for example, whenever we go and take properties to rehab and sell or to flip, then we typically don't have our lenders in or all into the deal any more than about 70% of the after repair value all in. So that means there's a 30% buffer, which means that even if the real estate market was to go down a little bit, there's still plenty of room for you to make money and pay your lender back. And I'll go more over just the due diligence process in a minute. But that's what makes private lending so powerful, is that you're lending on an asset that's not purchased at market value like you do with most other investments, but is purchased below market value. And then it's also secured by it's insured by the builder's risk policy, which means that if the house burns down, if a tornado comes through, something happens, then the lender collects the check because they're added as a loss payee on the insurance, or they should be added as a loss payee on the insurance policy, which means that the borrower and the lender both have to go sign the insurance check to get the money. So the lender gets paid off, then if there's anything left, then the other person would get it. And the other thing is massive passive income, because really, if you think about it, people that are wealthy, what do? They lend money out. I mean, if you go to any bank, they have the nicest buildings, they're making money. Now, they are making money on other people's money, like what we talked about, but they're still multiplying money. They're lending. They're lending money out, and somebody else is doing the heavy lifting, and they're getting a really good return. And that's essentially what you're doing as a private lender. And even comparing that to rental properties, with rental properties, you have to deal with tenants, toilets, and trash, your upkeep. But with private lending, you literally will give a check or disperse funds when someone buys a property, maybe do several draws for the renovation process, and you pick up a check when they're done. Now, some of you I know that have done this before in your retirement accounts. So I'm not going to go into a lot of detail about this, but I just want to highlight how this works. So the way that you can use your retirement funds for real estate. Now, this can be, we're talking about lending, but it can also be just other types of investments and other types of real estate transactions. But the way that you use your retirement account is you go and either set up a new account, or you will go and transfer or convert money from another account, from maybe a previous employer where you had a 401k, and you'll convert that money to either a Roth self-directed IRA or a solo 401k. And that will allow you to self-direct your retirement plan, which basically means you have control over the investment. So if you're self-directing, it's not someone else managing your money. And see, that's even what happens with most retirement accounts, is most of it goes into stocks and mutual funds, and those are the guys making most of the money on your money. But with a self-directed account, you choose who you invest with. So another way to look at it is, it's really the difference in investing in publicly traded assets versus private assets. So a self-directed retirement account will allow you to invest in private assets. And that's really the main thing is, you take the money, you convert it, you find a lending opportunity, whether that's through a networking event, you find somebody that has a real estate deal that you want to lend on or that you want to participate with, and then you start generating passive income. And then the point of all this is that it allows you to grow your retirement account tax-free. So just think about just a very passive investment to where there's not a whole lot that you have to do other than you identify an opportunity, you vet out your borrower and the deal, which that's, the work is up front, but then they go and they do the work and you generate the income. So when you use a self-directed account and it's tax-free, which means it's a Roth account, you're able to grow that retirement account and essentially not work as hard and not have to do as many deals because you're keeping more of your profit because it's tax-free. Now, not every account is tax-free. They're all tax-deferred, so the difference is, like with a health savings account or a simple employment pension plan or a traditional 401k, those are tax-deferred, meaning that you put the money in and you generate income, but then when you get the disbursement when you retire, well, then you start paying taxes at whatever income bracket you're in at that point. But with a Roth self-directed IRA or a solo 401k, which has a traditional component and a Roth component, you're able to grow the nest egg really big because you're not paying taxes on the growth. So another way to look at it is on a traditional IRA or 401k, you get a tax deduction when you make the contribution. So you're saving on the taxes from the money you put into it, but you're paying taxes on the growth. Well, with the Roth, you're not paying taxes on the growth. And as real estate investors, can we make more than the $5,500 a year contribution you can make in your IRA? Of course. I hope so. If you have any kind of legitimate real estate business, you're going to make more on the growth than just your minimum or your maximum contributions that you can make. So just to clarify, just in an IRA, typically you can contribute $5,500 a year to your IRA, but if it's a traditional IRA, then you get the tax deduction on the contribution, but you are taxed on the growth. But with a Roth, basically with a Roth, you can go and you could rehab and flip a house and make 30 grand, and you're not taxed on the 30 grand versus the $5,500. So what makes more sense? So it's the difference is, are you going to pay taxes on the acorn or the tree that it grows into? So I'm just saying all that to point out that when you use this to do something like private lending, it allows you to grow your retirement account significantly compared to other investments, and to grow it passively. That's the key. So what are best practices for private lending? So, and I'm going to go over these in a little more detail, but it's going to be knowing your borrower, it's going to be due diligence on the property, and then the security documents. So what do you need in order to make sure your money's secure? So number one is your track record. So you want to know who you're investing with. How many deals have they done? Have they paid their other lenders back? Have they made money? Or have they lost a bunch of money? What exactly have they done? How long have they been in the business? So you want to be able to identify your borrower's track record and who they are. And also their level of education. Did they go to, a couple of seminars and read a couple of books? Or do they have mentors and people like we do that are operating on a much higher level that teach us and mentor us with our real estate transactions? Have they just spent a few $100s on the real estate education and think they're a pro? Or have they spent thousands of dollars on the real estate education? Because there's a difference. So their level of education can tell you a lot about how they're going to handle your money and what type of properties they focus on. So that would just simply be, what do they specialize in? You don't want somebody that's just like they're a jack of all trades for real estate. I mean, for anything, whether it's someone that you lend money to, or even if it's a real estate agent, you want somebody that specializes in certain things. So what do? Do they focus on rental properties? And you can lend money on rental properties. You can lend money on whatever you want. But is it rental properties, or is it fix and flips? Is it new construction? Is it commercial? So find out more about their background and what they specialize in and how well they know those types of investments. And then what systems do they have? So we have a system for everything. I mean, if you're going to lend money to somebody, you want to make sure that they have their business in order. So we have a system for marketing and finding deals that other people don't know about. We have a system for analyzing properties and significantly reducing risk because we know what we're getting into. Now, it doesn't eliminate all the risk because any investment has risk, but it significantly decreases the risk when you have the right systems to analyze property and know your comps and your area and how much you're going to put in that deal. And you can very accurately predict, in most cases, what you're going to get out of it. We also have systems for hiring and managing contractors. So, most of you, I know, a good number of you in here already know, and you renovate properties. And you'll probably very easily agree with me that hiring and managing contractors is about 50% of your success when you're rehabbing and renovating and flipping a property. So we have systems for that. And then also systems for selling your property. So those are the things that you want to look at whenever you decide to lend to somebody.
So one note on that, though, the difference between a very seasonal investor in this business is that, for instance, like I never pay myself first, never. My lenders always get paid first. And if I don't make money because my contractor messed up and my timeline went past the time that it was supposed to, that's my loss, right? I always, because it's built on my trust with them, the loyalty and trust that I have with them, right? So that's part of the systems. That's part of the processes that when you're looking for opportunity out there to lend, make sure that you review that, right?
Yeah, that's a really good point because some people, and it happens. Those of you that have lent money, I mean, obviously there are people that won't pay you back, but that's the one thing that somebody that's experienced and that approaches it the right way and minimizes risk, they will make sure their lender gets paid back. They'll pay their lender before they make any money at all. And that's another thing too. I mean, if you lend money to somebody, do they have money in reserve in case things don't go the way that it's planned? So that is a good point. I'm glad you brought that up. Is pay your lender first. That's what you should do. So if you're borrowing money from somebody, you want to make sure that they can get paid before you make anything. So this is the property due diligence. So whenever we go to renovate or flip a property, this is what we're doing on our end. But if you are a lender, these are some things that you should expect from the person that you're lending money to. So you're going to basically, we'll send our lender a property packet with all the information. Now they don't all want that. Some do, some don't. And really, it really comes down to, how much do you trust that person and what makes sense for you. But these are some things that you should typically look for. So a property packet, which would include your comps, which is other sold properties in the area that justify your price, which is your ARV, that's your after repair value. So your comps will justify your after repair value to show that whatever price you're trying to sell it for makes sense. And guys, we coach people all over the country in multiple different markets. And that's one of the top things I see when people that are new to real estate. That's one of the number one things I see is, we'll be on a coaching call or a webinar and we'll review a deal and they're like, is this a deal? And I'll say, well, what do your comps look like? Your lender's going to look for that. And sometimes people, many times people will say, well, I've got 1 or 2 comps here. I found this on Zillow or whatever. But if you don't have at least 3 to 5 good comparables that are similar to that property in that neighborhood or within a mile of that property, it's probably, you're greatly increasing your risk when you do that. So that's one of the number one things to look at is do the comparables and does that market in that neighborhood justify the price that person is trying to get? And then a lot of people will try to, make money on appreciation. Now, appreciation is great. I think it's really better if you're, going for buy and hold, more of a long-term strategy, and then the price of your property appreciates before flip. You don't want to just use appreciation as part of what you expect to get. If you get it within a few months of rehabbing a house, that's great. But if the margin is really thin and you're like, oh man, I think it's going to appreciate 10% within the next 4 months, well, I mean, you can do that, but we don't do that. I just don't think it's a good idea. So I'm just saying, whenever somebody brings that to you, look at the comps, look at the ARV, evaluate the property based on today's value, because it's just a short-term flip. So that way you want to be able to know that you'll at least get this amount, or you should. Scope of work. So your scope of work is your detailed list of repairs that you give to your contractor. Well, I mean, your lender usually wants to look at that. If you go talk to a hard money lender, they typically look at that. So we'll send that to our private lenders if they want to see it. So that's the detailed list of repairs that we have decided to implement for that particular project. And our scope of work, I mean, it's going to include every detail about the property, everything from the paint color to the faucets to where to buy the product, all of those things. So that way, that's the other thing. So our contractors on our end, they know exactly what to do. They have a blueprint of how to fix that property, so that significantly minimizes confusion or miscommunication. But that, as a lender, that's something that that you should expect, or that would help you to determine, for one, is this person experienced in rehabbing, and two, what are they doing on this deal? Does it make sense? Oh, what happened? There we go. And then pictures. So pictures will help you to verify the repairs. It'll help you to verify what they're going to do to the property. So that's going to be just another way that you can take a look at what you plan to lend money on. Or you can just go walk their property too. That would be another way to do it. Inspection reports, I mean, that gets really detailed, but the inspection reports is going to be part of what we would pull our scope of work and create our scope of work off of. Typically, when we walk through a property, we have, like I said, a system to analyze properties, so we're checking off repairs that we're going to do. Then I typically will have an inspector go back through after me and say, hey, look, is there anything I missed? This is what I plan to do to this thing. Is there anything I missed? And then if there's anything else, we'll add to that. So your inspection reports will help you to know, to verify the scope of work, and also see, if there's anything else. I mean, there could be, plumbing issues or something you have to do from the house to the street. You could scope the drain line, things like that. But those will help you to verify what needs to be done to the property, so it reduces the chance that there's surprises when you start the project. And then a deal analyzer. That's essentially what I was talking about in terms of just a system to analyze your property. So once we get our repair cost, then we'll put our numbers in a spreadsheet. So the spreadsheet, the first thing we put in there is the ARV, the number we think we're going to sell the property for. And then it calculates everything else. It calculates our financing costs, our holding costs, our repair costs, our closing costs when we buy, and our closing costs when we sell. And it shows us our net profit, and it shows us what percentage return we're getting on that investment. And then what are your lending terms? So whenever you talk to somebody about a potential lending opportunity, what are the terms? When do you expect to get paid back? Or how much do you expect to make on that deal? So again, this is just going to be what you should see typically in an information packet whenever somebody approaches you to lend on an opportunity. And then you have the security documents, which is the promissory note and the deed of trust or the mortgage, and then the insurance policy. And then we also will do a lender's title policy too, but these are the main three. So the promissory note, those are the terms that you agree on, 12% interest, annual, whatever it is. And then the mortgage or the deed of trust, we're a deed of trust in Tennessee, but that's what secures your money to the property. Now you can lend money to somebody, you can just give them your money. You don't have to do this, but somebody that has a real estate education and that's experienced in doing this, they'll do this to help keep your money protected, because it's going to be the way to do it to where your money is secure. And then the insurance policy, the lender is added as a loss payee, which means if the house burns down or something happens, you get paid. So our summary is we've just gone over the anatomy of a private money loan, how to structure a private money loan, the advantages of using lenders in your business, and then also how you can benefit as a lender earning double-digit returns. And this is our contact information. We also have some sign-in forms if you guys want to just leave your information here, just feel free to write on that information form and just give it to us later. But this is our information here on the screen if you want to copy it down and reach out to us later. So we're just going to do a few questions real quick and then we'll wrap up. So does anybody have any quick questions on what we've talked about?
Eddie, what do you typically see as the interest rate that is being charged by private lenders in Chattanooga in the term?
It's, well, the thing about your terms and your interest rate is ultimately it comes down to what do both parties agree on, and that's why we're talking about the flexibility. I mean, it could be as low as 8%, it could be 12%, it could be higher. You know, typically most private lenders, I mean, just on a general level, most private lenders are going to get around 10 to 12% for their money. And again, that's strictly passive. You don't have to do any of the work. You give a check at closing, then pick your check up, principal and interest when the property is done. Now, hard money lenders typically, like I said, will raise money from private lenders and they'll charge a little bit more. Like typically hard money will be anywhere from around 12 to 14% and 2 to 4 points. So when I say percent, that's annual interest, and then points is going to be just what you pay at closing, or you pay that regardless of how long you have the property. So and Grace, it depends. I mean, I've seen all of it. I mean, we have lenders that will that do 10 or 12%, but then there's people that I've seen in the area that can get more. So, but ultimately, it comes down to the relationship you have with that lender, and also how much do you trust that person. Like as a lender, you could charge whatever you want. But the other thing is that if they're willing to give up a large percentage of the deal, how much experience do they have? Versus someone that's more experienced, they're probably not going to pay as much interest. So you have to also look at that as well if you're lending money. So it all comes down to your borrower and what your comfort level is.